What's going on, Investomaniacs? Your boy Knight Rider here. Today we're going to be talking about Best Buy and JCPenney. Up first, Best Buy. Best Buy experienced a decent second quarter. It was roughly as expected, but one standout point, their tech services boosted Best Buy's profit margin last spring. Best Buy's total tech support saw strong growth. Total tech support is Best Buy's $200 per year membership program for old people who need help signing up for like Pinterest and Snapchat. I don't know how to snap my daughter. How does this work? What's a booty pic? Best Buy's website and app also saw decent growth. An outsized portion of Best Buy's profits are coming from their higher margin services businesses like Total Tech Support and Geek Squad, as opposed to their lower margin retail businesses. This makes sense, as with their retail business, they're selling things that everybody else is selling, and when you're competing with, in the day of Amazon, you really can't make that much margin off of these products. It's pretty darn competitive out there. So I am glad for Best Buy that they are finding an area where they can bring on a little bit more margin. And this is something where nobody else really does this, at least at the scale that Best Buy does it. And nobody has the footprint at this scale, again, that Best Buy has for these services type help, where you can actually physically have somebody helping you, coming to your home, or you coming to a Best Buy store and being helped out. So I think this is one area where Best Buy will continue to shine. An increasing amount of Best Buy sales are coming from online sales as opposed to in-store sales. Best Buy has been pumping out money into improving its delivery services as well. They call that click and collect. Click and collect helps Best Buy shoppers purchase products either on their website or from the app, and then collect them at the physical stores in a quicker and more streamlined process. The idea is a solid way to tap into both the company's strong online presence as well as their brick and mortar footprint. I like Best Buy. However, the stock has ran up 26% in just the past 7 weeks, and that was in between quarters. So it's gotten significantly more expensive at this point, and just generally speaking, that's too far, too fast, particularly for a company like Best Buy. So I would wait for a pullback on this one. Up next, we have the failing JCPenney recently hired advisors to look into the company's debt restructuring options. The large retailer is starving for more time to meet its debt obligations that it'll have coming in kind of the next year or two. A Reuters report claimed JCPenney had held meetings with investment bankers and lawyers during the past few weeks to brainstorm options. The company needs to either raise more cash from investors, which would dilute shares an awful lot considering where the stock price is right now. I mean, we are literally 99+% below where the stock was at its all-time highs, like a decade-ish ago. Or they need to convince creditors to push debt maturities back, which, to be perfectly honest, if they don't push it back, JCPenney just might be going under sooner or later. So they might have some luck in the debt restructuring, because ultimately having a little bit of money come back over a larger or a longer period of time is better than not having the money come back at all. And at this point in time, JCPenney is just running out of money. The large retailer has approximately $4.7 billion in long-term debt, about $100 million in short-term debt. The company's revenue has been disappointing and slipping during the past 5 quarters. Why, you might ask? The department store chain has not been able to compete in the current competitive retail market with online retailers. The internet retailers like Amazon, this is still JCPenney here, have taken market share from the brick and mortar space, as we all know, and that results in the weaker retailers being kind of significantly squeezed, because the stronger retailers, they're going to retain most of the customers who are still going to brick and mortar, and plus other retailers kind of like Kohl's, like a Macy's, relative to JCPenney, they've done a better job building out their e-commerce platform. So on a relative scale, they are less affected. JCPenney just did a pretty darn awful job adapting into the e-commerce market, and it ended up being one of those weaker retailers. We actually thought, I mean, years ago, we thought it was a stronger retailer, but it ended up they just weren't able to perform at the level as some of their competitors were, and they have been very hard hit. In 2018, many of the top executives packed their bags and said goodbye to JCPenney, often a sign that a company is eventually going to go bankrupt. This included the company's CEO and CFO. That was last year in 2018. This year, kind of more recently, the senior vice president of finance, Trent Cruz, announced he too was also leaving JCPenney for other opportunities. Grass a little bit shinier on the other side of this street. Abandoned ship? One of the retailer's strategies in attempting to recover some of its losses over the years, they're trying to shift on the apparel side to focus more on categories like women's dresses and activewear, which are more, activewear in particular has really become more popular the last couple of years. And they're also focusing on less common sizes. That's a nice way to put it. Less niche sizes, shall we say? You see? You know what I'm talking about? Less like fat people and stuff like that. So will that work? I don't know. I mean, they might get a little bit more business from those niche sizes, as there aren't as many places they can shop. Having said that, I don't think that's necessarily enough to save this company. Although technically JCPenney did see a very, very small profit in 2017, the company overall has been losing money. So, and I don't mean overall as in over the past decade. I mean like every single year they've been losing money since 2012. There's no reason to get on board this ship. It's going bad. The top executives are leaving. I would stay away. Hey guys, that's it for this video. I put my portfolio up for full disclosure. You know what I'm in, you know what I'm not in. Let me know what your thoughts are, if you agree, disagree, or if there are any other stocks you'd like me to check out. I appreciate all the likes and comments, and make sure you're subscribed to Investomania, brother.